able to, one, have a network where you have these individuals in your network and being able to properly relay the opportunity that you have in that deal and how it can benefit them. Because guess what? That's how they got the money. That's how they keep the money, is by investing in real estate. What we're talking about all this week. And so we're going to dive in. We're going to look at, looking at the mastering the 4 C's approach at the end, but really how to get started with little no money, how to make an irresistible offer, because it's all about the offer and being able to lead in on what is the benefit for the person, the recipient on the other side that you're presenting the information to, that you're presenting your deal to where they can walk away and just clearly understanding what the benefit is to them with doing business with you and investing in your deal. Effective negotiation techniques, we're going to go through that briefly, but then also kind of how you can develop a diversified portfolio strategy. Wealth has no shortcuts, just like success in life, but there's a faster way when time and experience is wisely leveraged. You got to jump in. Like, we don't have enough time. I say it a lot. We don't have enough time to make our own mistakes. We got to learn from other people's mistakes. And being able to tap into that time and experience is going to give us the ultimate leverage to do what we want to do, which is fund these deals. So right now, so imagine you had access to all the capital you needed and you're ready to invest in real estate. What's the first type of property that you're going to buy and why? So we're going to take a second. I want to hear from two people and see what would be the top property class that they would buy and their rationale of why they're leaning that way.
I'll go.
I would go for a multi-property. I'm sorry.
No,
I would go for, yeah. Instead of going for a single property, I would go for a multifamily property first, because it will allow the passive income to come in faster instead of going for a single.
Okay.
So
okay.
The multiplication would, the figures would come faster. That would be my thinking.
I love it. Nope, 100%, 100%. And Leslie, you were about to say something too?
I'll just say ditto. So
yep, that's it. That's it.
I agree 100%.
Okay. Great answer, because guess what? You have access to the capital to do multifamily deals or any deals, for instance, single family deals as well too. And so that's the thing that you have to realize, that the money is out here. And now what is the process that we need to go through to get there? And so this is why we talk about how to get started with little to no money, because now if you have the deal, you have access to managing the deal and bringing it all together where you can provide the returns. Now the money's going to come to you, because guess what? You're offering a safe, reliable place to store their capital in this asset that you're controlling in order for them to get a better return in the future. And we'll talk about what their actual return and how we position that return as we go through the lesson today. So a couple of different ways that you can look at financing a deal. We're going to start with the most traditional and then transition into those that are a little bit more boutique, somewhat creative. But in regards to traditional mortgages, everyone should be fairly familiar with this. This is you leveraging the bank, getting a 30-year fixed mortgage, and being able to go and get the bank to provide the majority of the debt for this transaction. So you may be able to get away with zero money down for a VA loan, or you may be able to do like a FHA loan where you only have to put 3.5% down, or a conventional loan with 5% down. And that you can get those through credit unions, banks. You got different mortgage brokers, online lenders, and we're going to kind of go through some of the pros and cons for each one of those. But in this scenario right here, if you bought a $200,000 house with a $20,000 down payment and at a 4% rate, you'd be looking at around a $763 payment. So just using that kind of as a broad example right there to kind of real quick what that would look like. But going in, let's dive in a little bit longer or deeper towards banks and credit unions. So banks and credit unions represent about 45% of all mortgages in the U.S. When you think about your more traditional lenders, you got Bank of America, Wells Fargo, Regions Bank, which is heavy in the South, PNC. But they're personalized service. They offer relationship-based discounts sometimes. But some of the downside with those banks, there's stringent qualifications, including credit score, longer approval processes, and limited availability to niche loan products. And we as real estate investors, a lot of times, when we get out of just buying our personal residence, we need those niche loans to move out on in order to scale our portfolios. You got single family homes that's included here, condos, and multi-unit residential properties kind of fit within this construct. Mortgage brokers maintain their market share, originating around 18% of all mortgages in the United States. They have more products, a little bit wider range of products you have access to, expertise in navigating the process. They usually have a lot of volume, and they can get you there. They can get you across the finish line. And they usually can have competitive rates and terms, whereas they don't have a lot of overhead in some of the larger banks, where they got a lot of processes, a lot of departments and personnel, retirement packages, and multi double-digit million CEO packages and things like that for us, the corporate staff. On the downside, they're a little bit more on the expensive side, the fees and commissions that you have to pay them. You could have a potential conflict of interest and limited ability to provide in-person support. Usually they're more on the virtual side. But you see this full spectrum of various residential, commercial properties, including single-family homes, that you can leverage these products to purchase. Online mortgage lenders, they made up about 15% of all mortgages originated. And kind of the same thing. You got single family condos, rental properties. Their process is streamlined, competitive rates, and they usually have some type of customer support, but you lack the in-person interaction, which I think a lot of people nowadays, they're fine with that. We've become more accustomed to not dealing face to face, but you have to have the right framework of how you approach that to make sure that you're working with a credible individual, and that is someone that you haven't gotten referral from, and information like that. Because one of the things that I do, we went through in the 40 unit, we went through bridge debt with a mortgage broker that got us that loan. And I've had on a couple instances where he had new clients that were looking for someone that wanted to talk to a referral, someone that had done business with them in the past. And and I was definitely fine with providing that referral and just letting them know, hey, my experience with them just where it's to kind of help them with their business and just being able to pay it forward. Because that's one of the things with testimonials, and being able to let people know how their experience goes a long way for business owners. But one of the things that a lot of times people are less comfortable with online only experience. Before leading up to closing on that 40 unit deal with the bridge lender, I never had met him in person. It was just phone calls, phone conversations. There was some nervousness going through the process to like, hey, are we gonna get this over the finish line? And eventually, after we got the deal closed, and some months later, just being out in Las Vegas, that we actually got a chance to go hang out, do dinner. That actually was myself, and I think it was 3 or 4 of my clients. We were all in town for a real estate event in Las Vegas, and he took us all out to dinner, and it was on him. So it was really cool. Just build those relationships in your network. But you want to make sure that you're dealing with somebody that's credible at the end of the day across all phases of the real estate investing process. Government-sponsored enterprises. So they made up 65% all new mortgages that were originated. They were sponsored by some government enterprise. So when you think about these, think about FHA, VA, where it's that the loan is being sponsored. They're going to probably buy the debt, buy the paper once the loan is originated. And they have standardized loan underwriting guidelines. So you pretty much can go open the book up and see everything that you're going to have to meet in order to qualify for the loan. They're going to have lower down payment plans, flexible on the credit score. I was telling you guys earlier in the week that I had a buddy that said their loan product that they have for the VA, they could go down to a 520, which I was like, okay, if somebody's got a 520, they probably shouldn't be purchasing a home, but that's a whole nother story. But secondary mortgage market liquidity, because that's the thing, they're going to sell these mortgages, they're not holding long term, and they're going to get paid off their fees, and they're going to sell it to the government, and then they're off to underwrite the next deal. Some of the downsides, limitations on loan amounts and property types, they kind of have a box that you got to fit within. Restricted for borrowers with non-traditional income. If you don't have W-2 income, and you're self-employed, a lot of times it's going to be hard to qualify for these loans. They're going to just take you through the ringer in regards to trying to verify everything. And it's government involvement, regulatory uncertainties, things change. And sometimes these loans, it takes longer to close just because you have to go through so much paperwork. So affordable housing, single family homes, multifamily included in these as well too, that you have the Fannie Mae, Freddie Macs that provide lower interest rates than the broader market when it comes to commercial lending. Non-bank mortgage lenders. So they made up about 20% of mortgages. In regards to this, when you start thinking about non-traditional lenders, you can still buy single family homes. Think about fix and flip properties. So something that wouldn't qualify or wouldn't be able to qualify for like a government-backed loan because it wouldn't appraisal. The value would be too low. It needs too much work that needs to happen to bring the property up to code. It may need a roof or some of these things that are required for the house to have in a certain condition in order for them to approve the loan. It may not meet. And so you may have to go with a non-bank mortgage lender to get some of these deals done. And so they can have competitive rates and fees. Specialized underwriting flexibility. You can think about some of these like with the DSCR, the debt service coverage ratio loans. And they're usually a quick turnaround, efficient, but they're going to lack a physical branch location, less regulatory concerns. Some people that know what they're doing, they could care less about the regulatory. They think that's a good thing. And some people say, hey, it may be potential for abuse, but reliance on wholesale funding sources. So they have different funding sources, and that's why they had the flexibility to get deals done. And so it's always good to kind of have one of these lenders in your back pocket if you need them. Local community development financial institutions, not a whole lot we'll talk about this, but they really serve low-income communities and they help people who lack access to financing. And it's really focused on underserved communities and having that flexibility to get deals done for disadvantaged people who may not have that opportunity. They are limited in where their coverage areas are. On smaller loan capacity, and they may have certain eligibility requirements or restrictions on who can actually use those type of products. Private lending. This is one that I really love because the thing is it gives you the ultimate flexibility with borrowing funds from individuals, private institutions. For me, private lending was, it started with family and friends and just having conversations, talking with people, and them seeing what you're doing with your project. And then next thing you know, like, hey, I want to invest in real estate, but I don't have the time. I got some money, but I don't have the time to lead a project, to go through. And I can remember, the first time that I had my mom invest in one of my deals and how that conversation went and explain to somebody who really wasn't a real estate investor, who had some money and saw what we were doing and, and understood that I knew, I was like, okay, well, yeah, she knew that I was pretty smart, but she's like, okay, this is something totally brand new. But once she saw that we were pretty successful at it, that he was like, hey, I want to get in on this real estate deal. And of course, she wanted to have the non-traditional interest rate return on her money. So when I say you talk about somebody who knows how to negotiate, yeah, she was a tough person to negotiate with. And it was funny. But the thing was that I was like, okay, I'm fine with that because, hey, we're just getting started. We haven't really proven ourselves, and you're going to put your hard-earned money to work and go in. So we'll look at doing a larger share of the profit. And it was good. And, and that's the thing, like the confidence that you get in to see somebody that, you love, being able to have faith and trust in you to give you their money when you're going out and you're chasing your dreams, that there's nothing that replaces that feeling. And so that was kind of the beginning of it all. I was like, okay, let's go. And you kind of have more conversations, you get more comfortable, and you start having more opportunities. So, but with this is a potential, looking at a fix and flip project. If you need to borrow $100,000 from a private lender, let's go back here. There we go. All right. So you're borrowing $100K from a private lender at an interest rate of 8% for 12 months. If you were borrowing $100K, you're going to pay them $8,000 in interest over that 12-month period. And so you kind of have the flexibility. And one of the ways usually when I borrow money is I don't make monthly payments. that we pay back the principal and we pay back all of the interest at the same time once the project has ended. So in regards to, and that's usually the milestone is the property sold or at the refinance milestone. And that's when we'll pay our investors back principal and interest. And so that's one of the things that you can just kind of figure out what works best for you. What's the percentage? You know, a lot of people say you don't lead with the interest rate percentage that you want people. You just sit back and let them tell you what they're looking to get. And you can get to that point. One of the things that I normally do, I just offer a flat rate 10%. We recently last year, midway through, we started offering 12% return to our investors on their money, just because with where inflation was high, and then if you and the banks subsequently increase the return on your CDs up to around 3-4%, and so you want to make sure that it's something that makes sense for your investor, that it's a win-win for everybody. And so we increased our return to 12%, and so you can see there it's a $60 billion industry, $60 billion. And, you know, so that's a lot of money that's floating around. And we're talking about buying a $150,000 house. That's not even a drop in the bucket when you start talking about 60 billion. And so there's a lot of capital out here that's going and do it with private lenders that's lending on different real estate projects. So 23% of home buyers receive down payment assistance for family and friends. So the money's flowing around. I just talked about how I did investment property, and guess what? Mom was one of the private lenders that came on one of those deals. Especially when you start doing multiple deals simultaneously, that you'll have a lot of your capital tied up in between deals. And if you can't access it fast enough, you could potentially miss out on some really good opportunities that come your way. And so being able to tap into your network to raise capital, to bring money in where you can give somebody a return on their money, and at the same time, you're able to get into another project, that it's a win-win for everybody. So that comes in with the accessibility to the money, the flexible terms, the personal relationships that you can leverage those to be able to tap into private lenders. But a lot of times, hey, if it goes sideways, you don't do what you say you're going to do, it can strain relationships. So it's a double-edged sword. And so that's what we really, really preach is that's why you're here right now. You're getting the information. You're in the communities where you can ask the questions, where you can get in front of making mistakes. You can have people that you can ask where now you're not putting people's money at a high risk because you know what you're doing. You got the information, you got a coach, you got a mentor, you got a community right behind you, whereas that you got multiple eyes on your project where you can't fail. And a lot of times if you do informal arrangements, we always use promissory notes and always personally guarantee all the capital raised that if something goes sideways, then hey, you got a guarantee that you're going to be paid to be made. And you can use this for residential fixed rental properties, multifamily. We're going to talk a little bit more specifically about how you can set this up within the multifamily construct, a little bit more efficient, and you can move expeditiously to some of your deals. Hard money lenders, I love hard money lenders because they provide money. So yesterday when I was in the airport, I actually had a meeting with my preferred hard money lender that I've used for the last 2-3 years, single family, and we did use them on a 12-unit loan as well too. So they represented over $10 billion in 2023 for the lending. They're fairly quick, asset-based loans where they don't really look at your credit scores based off your experience sometimes on what rate they give you, and then it's based off the actual asset, the deal itself, that they want to make sure that you're buying a deal that has really good upside and you're not overpaying for it, and that your renovation budget is realistic. On the downside, they usually are higher interest rates and they're short-term loans. The conversation that I had with the president of lending yesterday was around, she was told that she needed to reach out to me to give me preferred pricing, whereas that I would bring more deals their way. And I said, oh, okay, yeah, we can definitely have that conversation. And so they ended up at taking a half a point off for his origination and a half a point off on the interest rate term. So 12-2 right now for us. Kind of, you could probably get a little bit cheaper. Usually, you know, if you're paying for on the personal lending side, a lot of times you're not paying those 2% points on the loan amount. If you're going to a private individual, some will charge you points. But one of the things that you look to do is like the better that you become at raising private money, your money cost goes down, that you're going to ultimately save money by being able to raise money from private individuals. And it's less paperwork and less processing than if you were going through like a hard money lender. But you want to have them in your pocket because they have unlimited capital. They're backed by like a fund. They can access money to do virtually any deal. And I talk with them about some new development projects that they're thinking about with some land that we have access to. Yes, case by case basis, they can be creative with how they put the deal and manage the deal because we have a good relationship and they're veteran friendly, whereas they lend nationwide to vets. I see Donnell that double back. He was like, hold on, what are you talking about over here? I got you, Donnell. I got you. I got you, because that's the thing. They lend to veterans and they lend across the state of Texas to anybody. And so that's the thing that is really on relationships with these lenders. And so that's one of the great things that that you can do with building relationships, that you can move deep where you can get
Johnny.
somebody. Yeah.
Yeah, I think it's not just me. The audio is a little bit, choppy. It's breaking up a little bit.
Okay. Is it better now?
Try it one more time.
Is it better now?
Yes.
Much
Okay.
Much
That's
better.
better.
Much
I
better.
thought it was
Okay.
just on my end, so that's why I'm not. Okay, probably my signal, but since Leslie brought it up, yeah, now that's better.
No problem. So
Yeah.
it's computers using my phone microphone since my headset wasn't working, unfortunately. But yeah, we're still good and we'll keep pressing.
Yep. Let's go. Thanks, Leslie.
You said it's still choppy, Joel?
Keep talking. It was.
It's good now.
That sounds better.
Okay. All right, cool. So yeah, so that's hard money lenders. And so there's plenty of hard money lenders out here. I work with different lenders over the years. And the thing is you want to have at least 2 or 3. Whereas that if one says no, that you're not stalling out or missing out on the deal because somebody said no, that you have somebody else that could probably step in and provide the funding that you need for those. All right. Private equity firms. So now you kind of get into the big fella here in regards to Wall Street and how they do loans where they have billions of access and they're looking to usually invest in larger deals, commercial development, where they have access to get a higher return on their money and they can deploy a large amount of capital at one single time. And so you can see here represents 158 billion for what was raised and funded in 2023 with private equity firms. And they're usually, large capital base. They got a lot of access to a lot of capital, professional expertise. You can lend them as guidance. The thing usually, with your hard money lenders, that they're an extension of your team. And so they're looking over the deal. They're not going to let you get into a bad deal because guess what? They got to be a good steward and fiduciary of their money. And so they're underwriting the deal just like you. And so one of the things that you want to make sure is that you're doing your due diligence up front. And we're going to talk a little bit about that a little bit later on tonight as we kind of go through. But for some of the downsides, you got higher fees usually. You lack control and long lockup periods. And so it's kind of the gift and the curse with being beholden to the private equity firms because they provide so much money that they get a little bit more weight and sway in how the deals exited and the terms and everything like that, which they usually work into their advantage. All right. So that's private equity firms. Kind of looking at the crowdfunding route, represent a little bit smaller. We saw 63 billion, 150 billion when you start looking at the private equity funds, but crowdfunding is something new, fairly new, that you see here with only represents 1.5 billion. So they have a little bit lower market share in this space. Usually it's a lower minimum investment, and to get into some of these deals, it's just spread across so many different investors that can invest, and you can diversify across multiple assets, and you have somewhat transparency, but you have limited due diligence, limited opportunities to early. And so a lot of times you see this on like larger residential or value add multifamily. Yep.
You're breaking up again. We don't want to miss the things that you're saying, so. While we're waiting, Henry, you want to share what you have going on right there?
Hey,
Yeah, I
hey.
just want to give a shout out to Henry. Congratulations on the deal that you have actually under contract. Yesterday, was it yesterday?
Yeah, we found out today that everything's been signed and solidified, but yes, technically today we are under contract.
Congrats.
So yes,
Let's
moving
go.
right
Let's go.
along.
Let's go.
Let's go, bro. Let's go. Yes, sir.
Awesome. Awesome. Yeah, we're going to talk about that in a few minutes. For sure. How's it now, Faye? I switched off the one network to another. Okay. Let's see if
You
that works
sound
better.
good. You sound good, bro.
Okay. Let's press. So yeah, so that's crowdfunding. You get limited due diligence and there's limited opportunities there. On the creative financing side. So this is kind of where the rubber meets the road. You got seller finance and lease options subject to it was funny. I was talking to one of my clients today, who was looking at doing a subject to help someone up that they knew that they were a power of attorney for someone that needed help with their house and how it was set up with the assistance to help them with that deal. And so they were going through and were asking for us the details, like how can I approach this? Whereas that they're gonna have to one turn over the real estate and don't know what to do with the real estate, and she's power of attorney and she's trying to take care of the lady the best that she can. And so, and I talked to her about the subject to transaction, and so we'll dive into that. But that's the power with creative financing, that it gives you the flexibility to be able to solve people's problems. That so happens that it has a house that's centered around it. And it was a pretty good deal because when we looked at kind of where in the market, it's probably be worth around 230, 240, and the lady only owed about 80K on. And so she was looking at taking over the existing housing payments and creating a win-win for everybody. And so, like with this scenario here, if you wanted to purchase the property, but you didn't have enough for a down payment, and you negotiate seller financing terms where you can make a payment of $1,200 for 5 years and effectively finance the property without the need for a traditional mortgage. So the whole premise of like being able to get a deal done, and one, the seller finances the deal because they don't have a mortgage in place, they don't have to pay anything off, they own it outright, and they can become the bank and they finance it for you. Or you can take over the transaction and keep their loan in place, and now you can move the title into either a trust or a land trust, and now you control the property and are the trustee for that transaction, and now you can do whatever you need to do with to get the deal done. And so you had the flexibility. Then you had a lease option where now you can have the lease option. You can actually roll these in with like some of the sub two transactions and present a lease option where you can bring someone in, they can give you a down payment, and you give them the option to purchase at a pre agreed to purchase price in the future. And if they don't execute that option, then guess what? You still own the property. You're making the payments, and then you can look at potentially selling it on a lease option to somebody else in the future if they didn't want to exit it and they moved out. And so you get a lot of different possibilities on the creative side with being able to do these deals. Seller financing transaction. I remember the first seller financing transaction that I ever done, and it was on a duplex that I bought. And the guy was just telling me his story. He was a real estate investor. I think he had like 20 properties. And it was after the hurricane. This duplex had got really damaged bad. And I wasn't quite sure if he had insurance on it or not. But he was telling me that he was working on so many other properties over time, and he hadn't got to that one. And he was telling me the story how one of the properties, because it had a billboard on it, and he was saying how one of the properties that he had on the other side of town, that it was along the easement, and the city had to buy a portion of the land, and he was complaining because he was mad because they took his sign down, and because it generated some passive income for him. And he had talked about how he had seller financed that property that was on the site there. So when he said that, my ears lit up. I was like, huh. I'm like, so would you consider, with a down payment we agreed to, with seller owner financing this deal? And he said yes. And so we ended up buying the property. Originally, we had it under contract for $55,000. And he was like, well, if I'm an owner finance it, how about you pay a little bit more and you put $10,000 down, and we're gonna call it a price $60K. And so I was like, yeah, that was fine. And so we bought the duplex $60K. We put the $10K down, and he owner financed it. And then we went in eventually, like over the next 6 months, because we had other projects going on, did the renovations. Then we did a portfolio loan with the credit union, and we paid him off. And we actually got about $20,000 back from the loan, tax free, and cash flow, and just went off and doing more deals. And so you can put these deals together, but having the awareness of how to do it, and then the subtle conversations that you have, and listening in to little keys that can tell you where an investor is and what they may be open to, what they may not be open to, that it gives you your left right boundaries on how you can put the deal together just like that. And go from a traditional, hard money loan, or me doing private lending and raising the money, to, I know with this one, I can do seller financing. I can raise the money that I need to do the renovations, and we can get in and get out in less than 6 months. I can give them a return. I don't have to put any money down, and I can refinance this. I actually could pay them back with a portion of the extra money that I got tax-free from the loan. And then now I have 100% ownership, and I have all the cash flow coming in and 25% equity going forward for the duration of the loan. And so that's the thing that you have to do with the flexibility that comes with it. You can close faster, and if you're good at negotiations, then you can create a win-win situation. On the downside, it is a risk for the seller. They're taking a risk, but they can foreclose on you. If you don't pay, they're going to just foreclose on you, just like the bank would. Not all sellers are willing to offer it. So that's the thing. You got to be having someone that's willing to meet you and provide the seller financing. And sometimes you're going to you may have a higher interest rate, but you may not. Some buyers, you just go in, like Coach Chris talked about last night, that he negotiated a deal where he just said, hey, I'm going to pay you X amount each month. And they were fine with it. They didn't even talk about interest rate terms. And so it's all about how you present the deal, and what you're willing to. If you're a really good person, they like you, then they're not going to probably push back a whole lot. And so it's all about building rapport and being able to know what incentives someone's looking to, or what challenges they're looking to have solved, so you can create those win-win scenarios. So love seller financing. And, and I talked about earlier, the last deal, we actually done 3 in the last couple of years with clients, but the most recent right before Christmas last year, that we bought a 20 unit with 100% seller financing, and we bought out a minority owner. It was a minority owner who owned a stake in the deal. And so for his 80K position, we bought him out $40,000 that we brought to the table. And now when we refinance this, we're going to get paid back $80,000 out of the proceeds, because we own a minority stake in the deal. And the majority owner gave us 100% financing from his side. And so you until you have the conversations and you look at the deals and you're talking with someone, you're limited by your creativity with getting this done. You can use it on a single family situation, but you can use it on larger commercial deals. And I'll say it's easier on larger commercial deals because the owners are a little bit more savvy and sophisticated. They've seen it before. They know how it works. They know if they haven't kept up with maintenance, or if they haven't got the occupancy high enough. They know you can't even go qualify for a traditional loan. So they know, hey, if you bring me a down payment, then guess what? If you go raise $200,000, you don't really have to even come out of pocket with some of your money. and then you get into a deal, and then that way you can actually get into a multifamily deal without even having to bring money out of pocket, because you can raise the down payment, that equity that you need, and then the owner financing can provide 100% if they choose to, but maybe they want a 10% down payment, and you just bring 10% to the table or 20% to the table, and they'll bring the other 80%, and now you're locked in. And you can easily get terms for 2 or 3 years where you can come in, do the improvements, pay them off. Or I've seen seller financing terms where they actually finance the property for 30 years, just like the bank would. And you got a low monthly payment. You're paying it from cash flow from day one. And yeah, and you're building wealth. And that's what we say. You like, one deal can change your life. And there's not no prerequisite that you got to have X amount of money, that you've got to done X amount of deals before you can go and do one of these transactions. You just need the information, and you need to get in front of the right seller. That's it. And the community where you can go and get the resources that you need. And so that's why I say, it's like, you don't have to have all the resources, but you got to be resourceful. I'll say it again. You don't have to have all the resources, but you have to become resourceful. And if you do that, then the sky's the limit. Lease option made up on 3% of residential property transactions here. The average option fee was around $5,000, with the median lease term being 24 months. It's a low initial investment, potential for appreciation, option to purchase the property at a predetermined price. But the downside, you don't own the property until the option is exercised. And this is more so from a buyer perspective, the risk of forfeiture and complex legalities. And so you want to look at that. You can use this single family or on commercial side as well too. And so you're kind of looking at that as a option that you can have in your toolbox in regards to how you can get deals done. Sub 2. So Sub 2 made about 4% of the residential property sales in 2023, totaling $20 billion, with a median discount of 10%. So no qualification requirements, immediate cash flow, potential for equity capture. Usually you got to watch out. The due on sale clause risk potentially is something that could run into the issue if you don't do it the right way. Liability concerns, just where it's that you're somebody else is on the hook to pay the person's mortgage that had the original loan, and then a limit availability that you got to find the right scenario to kind of put that in place with the owner. But, distressed properties with existing mortgage, this is a great option when you start looking at like the last 3 years, with so many homes that were bought with 2, 3, 4% interest rates, that now you have a lot of properties out here in the market that have these interest rates that are really, really low. And so if you can go in and do a Sub 2 where you can take over the financing with a low interest rate loan, in today's environment, that debt itself is worth a lot of money, because rates are going to be around 7% for a while. And to be able to lock something in with 2 or 3 years, with a 2 or 3% interest rate for 30 years, that we're never going to see those rates again, probably in our lifetime, unless something extremely crazy, another pandemic or something happens. And so it's a great opportunity with Sub 2. Joint venture partnership, I love this one, especially with small commercial apartment buildings. It represented about $100 billion, 8% of transactions in 23. Because you can get access to capital, the risk is spread out amongst partners. You can leverage diverse expertise and skills and networks. And for me, what I really loved about it is because now you can bring a couple of people together. You can buy a small apartment building, and as long as everybody's on the same wavelength, you can have a business plan set up where you don't have to sell the property in 3 to 5 years, which you see with more normal syndications. And we'll talk about syndications, about how, that's another way you can buy apartments, whereas you have a larger pool, you have more than just 3 or 4 private individuals or investors that provide the capital. And usually they're going to get their money back in 3 to 5 years is usually the time frame. You go in, you buy it, you do the improvements, execute the business plan, then you sell the asset, and everybody gets their principal back, then they share the equity based off their ownership, and then you got your money, then now you're looking for the next deal. But I really like joint ventures because if we find a great deal, I don't want to sell it. Like, if I can get into a great deal, why would I go and sell it and then have to go find another great deal? Because it gets harder to find deals. And so now if I can find 2, 3, 4 great deals and I can make $3,000, $4,000 off every deal, it's like if I wanted to stop after year 4, year 5, I got my process, I got my properties, I got the long-term appreciation that we're going to pick up with it. We got the cash flow, we're paying down our debt, and What else do we need? And so that's the thing, that when you start looking at long-term wealth, it's a long game. It's all about ownership and having assets. And if you find good assets, you don't want to have to be in a position where you have to sell those assets and start now and go build another portfolio. Because the goal is to build up the passive income, the time freedom, and we're not going to really sell that away, because we know the goal is long-term ownership. And so that's what I love about joint ventures, because it allows you to do that in this space with commercial apartments. But on the backside, you got consensus on major decisions. You need to make sure you have your operating agreement tight, where it's managed, member led, whereas that you have a manager that has experience, that's leading everything. Where if you have disputes, at least you got to have somebody that's experienced that can make the call whenever decisions need to be made. Sharing profits in a partnership, which is okay. We're going to talk about that with the 4 C's, about the collaboration and just being able to partners, whereas that now you're able to get into deals and you don't have to have everything be under you, and you can diversify your risk, because guess what? You're not bringing all the capital in. You're not doing all the work for managing the project. And now that's spread out amongst other people. And now you can do that across different assets and different geographical locations. And we'll talk about some of that diversification. Complex legal agreements. It's complex if you're trying to do it by yourself, but that's why we hire attorneys. We go through the paperwork. And that's one of the great things with my clients, that we give them all the paperwork. Like with that 18-unit deal that we talked about, the legal paperwork was $5,000 by itself. And so going through the operating agreement, the subscription agreement, the private placement memorandum that we gave to the investors that came in with the deal, that now, hey, giving them these structure, these documents, you can create it and now give that to your lawyer to make modifications to, versus you going to pay them to do it from scratch and paying $10,000 to have those documents put in place, versus going through like, hey, read over this, tell me what we need to do and change. That is a whole totally different construct, and you're not paying nearly as much for a lawyer's time to review something versus them creating it from scratch. And it's varied investment goals amongst partners, and that's the thing. You want to make sure that everybody's on the same page when it comes to the business plan and doing it. You can use this for large scale developments, commercial properties, we talked about that, or other complex projects. So right now, imagine 5 years from now, and if you could achieve your ideal vision of financial freedom, what was the first thing you're going to do? We're kind of breaking it up. I want to hear. I want to hear somebody, they want to go to Fiji. You know, somebody wants to go see the pyramids. Somebody wants to go buy a Ferrari, or whatever it is. They want to go climb a mountain. What's some things that you guys want to go do, guys and gals?
I have Fiji on my bucket list. So Fiji,
Okay.
Fiji's up there. It's right there.
Nice. That's on mine too. I got to get there.
So our family has a picture of the Maldives on the refrigerator.
Mm-hmm.
We've been talking about that for a couple of years. So we
Okay.
definitely want to do that. My daughter is learning Japan, and so that's on the list.
Nice.
So we got a couple places that we'd like to visit.
I love it. I love it. I love travel, especially travel with family with experiences. I told my kids that, for my first time getting on the plane was me flying the basic training the summer between my sophomore and junior year in college. That was the first time I got on the plane. And it's like now these kids, they got passports, when they're 2-3 years old, and been to Paris and Europe and different places. That it's crazy, but it's a blessing. And that's the thing, is like, you got to figure out with financial freedom, time freedom, what it is that you do. And I'll tell you, it's not all about the money. It's not about, for some people it is, getting the private jets, the cars and all that stuff. And that if you think that makes you happy, you're going to be in for a rude awakening once you get it, and you start scratching your head, and you don't have solid relationships, no solid communities, no solid family relationships, or you did all this hard work and you turn around and look around and you're by yourself. It's like, it's no fun in that. And so being able to think through the things, and we talked about this week earlier, is like understanding why you're doing what you're doing, why you're showing up, why you're putting the extra reps in. Why are you, going through and facing all this adversity? What is it for? And so if you can figure that out and you know why you're locked in, then you're going to be better for it. So something to just kind of think it through, just instead of me just talking. Anybody else want to share?
Yeah, Johnny, can you hear me?
Yeah.
Hey, I'm driving right now, but I want to go deep sea fishing, charter boat fishing off of Mobile, Alabama. That's what I
All
want.
right, you in my neck of the woods. You gonna invite me?
Yep.
Let's go. Let's go
Let's do it, man.
for sure. That's a good time. That's a good time. Long as
Oh, yeah.
long as we not going like 4 hours out. You know, deep sea for me is about 5 minutes from us not being able to see the shore no more. That's deep enough for me. Let me put that out there.
You gotta get to the big fish, John.
Man, hey, that's all right. Hey, listen, I'm fine with 2 or 3 little ones. But but I think that would be a great bucket list kind of thing. That definitely would take me out of my comfort zone. I'm gonna have to have my life vest on, and I'm gonna have to have the Coast Guard on deck, like around 20 miles away. Where like, hey, is something going down? Like, I need y'all ready.
Yeah. Yeah.
No, but I love it.
Yeah.
So making an irresistible offer, what does that look like? Step 1. So now that we found a deal, we talked to a seller, they warmed up, they want to go the next step with us. Now we need to look at, hey, we got to get information so we can kind of set a baseline on what we get out of the property. So number 1, we want to analyze those comps. We want to look at comparable sales. We want to look at, hey, what are the property charges for rent in this market within that zip code or within that area, that side of town. We want to consider the property's condition and then what's the potential for appreciation along that area. So that's step 1. Then we want to kind of move in and look at step 2 and identify the profitable opportunities. How can we increase value, reduce expenses for this asset? So now we're going to be looking at things like how we can increase the market rent. Is there potential for doing renovations that where now we can increase what we charge for each month? Can we reduce the utilities? Whereas now, once we turn over leases, that we can have them start paying for their water, for their sewer, maybe for their cable, if we're paying cable bill, or things like that. You can look at other creative opportunities where, depending, you're going to charge for parking. If you're in a major metropolitan area, people may pay for a garage, for access to storage. If you're like out west, if you have covered parking, that's a premium.
It's just a matter of, how badly do you want it, and learning all these things to wrap things up when it comes to like the financing, because most of the time, even if you have the access to capital right now, what Johnny is sharing with is more of the leverage for you. Like you have those funds that you already have right now, but these are the other things and how you can scale up even more and faster. Take it away, Johnny.
Get that value to your property.
Awesome. So what we're gonna do on this one is
you want to look at
we were on 3. Let me step back.
So next you want to look at financing options. Talk a little about there earlier.
There we go.
So
step
you want to
3.
look at, hey,
So step 3 of the 4 steps is really getting your financing options ready. So you want to look at how you're going to structure the deal. Whether you're looking at traditional mortgage, a bridge loan, hard money, your private money. We're looking at the lease option, or you want to do a JV partnership, or you're going to do like a traditional multifamily syndication where you're bringing a whole lot of investors and you just have a management team and you break the deal up. Kind of general partners usually get 20-30%. The lending partners or limited partners who do provide all the money, they usually get 70 or 80% ownership of the equity in the deal. And the general partners, they run, execute it, and manage it. And then they get paid a little bit along the way, and then they usually get a chunk of the equity on the back end. So you want to just look at how you want to put the financing options together for the deal, what makes the best sense for this one that you're looking at, and really go through there and looking at how you can maximize your returns and minimize your risk. Step 4, you want to do your due diligence. You want to dive in looking for any issues, any potential risks that can come back and bite you and can prevent you from executing the business plan as you're laying it out. So you definitely want to look at the physical property inspection. We're looking at everything from the roof all the way down to the foundation, and actually underground. We're looking at the sewer, water lines. You want to snake the sewer lines with a camera, especially for older properties. Make sure there's not any cracks or anything that you have to deal with. But then also you want to do a financial audit and look at the rent roll, the profit and loss statement for the property, looking at all the expenses, that they have, the current leases that they have for the property, whereas now you can make sure everything that you've been given, it actually matches up with the actual no-kidding data that you got from all the actual information from whether they sent you soft copies, usually now. But a lot of times landlords, they just have that stuff hard copy, especially if they're self-managing, and so they may have to upload all that. And so that's one of the things you want to look at with the regulations as well too. Just make sure you're not caught sideways with the county or the city in regards to any violation. And then step 5, develop your exit strategy. You always want to have that exit strategy. When you're going in and making your offer, you want to know how you're going to end, because guess what? We make money in these deals on the front end when we buy, because we thought about our exit strategy up front, because we underwrote the deal up front, because we did our due diligence up front. That's how we make money, because we don't go through and just jump into a deal and without going eyes wide open. I was actually, this morning when I didn't go to work, that I was waiting to get a prescription filled. My buddy, who's in Thailand right now, he's moving to the DC area, and he was looking at a property, and the realtor told him that he was going to have to go. The property was in Alexandria, 850, and he's still like, yeah, you're probably going to have to go up to 930. You need to waive your appraisal. You need to waive your property inspection report. I'm like, bro, you're moving here in July. I'm like, you don't need to be that aggressive, and you don't need to be waiving your property inspection report on a house that's 30 years old. Or I think it's maybe a little bit older than that. I'm like, take your time. I'm like, don't feel like you got to be rushed and pushed into, waiving all these inspections and things, because they're important, because they're going to protect you and protect your investment by getting all that stuff done on the front end. So you want to look at your exit strategy. You want to understand, hey, the income that you can potentially make. You're going to look at flipping it short term. You're going to hold it long term. You're going to refinance it and keep it, or what it is that you're going to do. Maybe you're going to just raise private equity debt on it, and now you're going to pay that second position debt off when you refinance it. You keep the equity and own it long term. So you got different strategies on how you do that, in the returns that you're going to give your investors in order to make sure it's a win-win for everybody. Now we're going to kind of jump in and analyze a deal together. I know we're a little bit over 9 o'clock already, and but we only got a little bit left and going through. And so we're purchasing a residential property to rent out, and kind of doing your research. You ended up with a house listed for $250. You ended up putting $50,000 down, and you know that you can rent it out for $2,000. And so kind of your goal is to see where you are from a return on investment perspective, and then really just make a decision. Hey, is this going to be good enough for you or not? And so taking this into account, you end up with a total annual expenses of $7,100. You can see kind of the breakout there. And then looking at the net operating income with just taking your rental income and subtracting out the annual expenses. And so income minus expenses equals your net operating income. And so this one, when you look at kind of where would I be on a cash on cash basis on the return if I knew that I had to put $50,000 down on it. And so you put that $50K down, and now if I'm making $16,900, where is it going to end up being at? And so this is an example we're going through, we're looking at this deal, that one thing that we didn't take into account on this one is the monthly mortgage payment on this one. But really, because what I wanted to get home is really calculating going in on the cash on cash return and how to calculate that based off that $50K. And so doing that, you were looking at, it was like, okay, if my NOI is $16,900 on this, and we put a total of $60K in it, when you look at your closing costs, your initial repairs with your down payment, then now it's like, okay, what is my cash on cash return that we would be looking at? And so just from this kind of example here, there we go. It would be 28.17. And if going in and looking at it, you're like, okay, it's 28.17. So this is an example when you're going through and looking at it, that your return is going to be a little bit lower than that when you bring in making that monthly debt payment. But for this example, with the cash on cash return, the situation with the NOI and the expenses, you're going to be around 28% when you do the math. And this, looking at the cap rate, kind of same example, that you're going to go through that $16,900, and now you're going to divide it by the original purchase price. And so if you look at what you bought it for and the income that it's producing on an annual basis, that you're looking at around a 6.76% cap rate. Most of the time when you look at the cap rate, that's going to be reserved for like commercial buildings, 5 units and above, that really you leverage that cap rate to compare like and similar deals. And then based on that analysis, now you're kind of looking at an NOI, you're looking at your cash on cash returns, like, okay, based off that asset, and I know for this area, what I should be getting, what others are paying, is this a good deal for me? And it's subjective, because now you have to make a decision for you and your risk tolerance and your return on cash that you want to receive. Is this a good deal for you? And only you can make that decision. But you want to take all the information. That's what we do with any of these deals. You get as much information you can, you synthesize it, and then you have to make a decision. You make an educated, informed decision based off your knowledge, based off the other people on your team's knowledge, and all the data that you have to see, hey, is this a good decision? Is this a good investment going forward? And I think that's the biggest thing. So now, after you got the deal, you know how much you can pay for it. Now you got to negotiate. And now you got to understand. You go in. And so as an intelligence officer, what you do, I love this, because now you're doing your preparation, you're researching, you're learning everything about the individual, their biases, their tendencies. And it's almost like you're doing homework, just like for the opposing team. You got the whole week in the NFL that you're looking at your opponent, you're looking at their quarterback, you're looking at their star players, you're looking at their tendencies. They tend to dribble with their left hand. You want to use a basketball analogy. Like they're going to pump fake 2 times if they're on the left side of the court, and then they're going to shoot. Or, they're going to always look when they come through, they're going to hand the ball off, they're going to cut through the paint, double back in this situation, and then try to take the shot. And so now you're studying your opponent. You're looking at everything that you do, whether you're researching their LinkedIn profile, their Facebook profile, you're researching court cases, and you're like, oh, hold on, this landlord, he's been in eviction court 10 times in the last month across 4 different properties. So it was like, okay, I know this guy's probably burnt out. I see this case, he's been dealing with some problem tenants. I see he's had to evict a lot of people. I see he's got a lot of notices from the county in regards to him not meeting standards in regards to delinquency when it comes to meeting code, that he's got multiple violations on his properties. I see here he hadn't paid his taxes. He's been tax delinquent. And so now the more you research, looking at those databases for like court records, for certain names, for the company name, or you're talking to people, or you're looking on the profile to kind of understand what they're doing. And now just have a conversation with other investors that you meet up, or people that's been in the area for a long time, because people know. They're like, oh yeah, so-and-so, he's been investing for 40 years. He's like, yeah, man, I know that property. I tried to buy it from 2 years ago, and this was wrong with it. And he was trying to sell it for 1.4 million. It's like, oh, it's like, man, we talking about 850. I'm like, okay. He's like, yeah, it was a great property, but he just wasn't motivated, man. It's a great area and everything. They're building the Starbucks down the street, the Publix. I'm like, really? Yeah. He's like, yeah, you didn't go. Yeah, they just brought that up at the city board. The city board, they just approved the permits for new construction down the street. They're going to tear all those trees down and build like a $10 million project. It's like, oh, okay. And so now you get as much information and research in the area from all these different places. And the more you're connected, the more rooms you're in, the more conversations that you have, then now you bring all this together when you go into a position to negotiate, and you're willing to go in and have a conversation. And not if you have all this in the background that's happening, and the buyer says, hey, you want to be at 850, he wants to be at 900. And you go in, it's like, well, I can come up to 860. Like, well, not going any lower than 880. Like, okay, cool. I'll take 880. Because guess what? All the upside that's there. But if you had done your research and everything, and you just kind of had a limited amount of information, you may have just stuck to your guns. Like, well, the underwriting said, Johnny said, I need to get an 8% cash on cash return, and I ain't going above that. I'm like, hold on, but they're building a new school, a new Publix, a new shopping center down the street, and all this money and jobs coming right down the street. I'm like, your appreciation in the next 5 years is going to probably double or triple in value. It's like, but you said 8%. No, that's why we take all the information in. We make informed decisions like, hey, we know we're not going to get exactly an 8% return out the gate today, but the property is probably going to triple in value in 5 years just because of all these other factors. Like, oh, okay, well, it's still a good deal, even though I'm not getting 8% right now. And so that's what we want to talk about, having the information research where we can become an astute investor and we can do deals. But you want to be prepared. Focus on win-win. That you want to, hey, if the seller said he wanted to be at 880, you look around like, can I pay that? And a lot of times like, hey, I can pay that, but, and now that's when you drop your terms. And that's a whole nother strategy we don't have a lot of time to go through, but really the terms drive what you're doing. Because, hey, if he wants to get paid that, it's like, hey, if I pay that, that means I know that my bank said, hey, the most that we're probably going to give you is this loan to value. I'm going to have to bring this extra money to the table. Like, well, hey, can you hold back $100,000? And I pay you that back over 3 years instead of giving it to you at closing. Like, yeah. I'm like, okay, cool. Well, with those terms, yeah, I can pay you $880. Because now that's $100,000 that I don't have to raise for my down payment. And now I'm good. I just got to find my closing costs. And I'll pay you that out the cash flow. And I know that we got the money for the renovations and we're good to go. And so now you kind of work that win-win. He wants $880 and I don't want to have to raise a whole lot of money. And so now we figure that out together and he gets his price. I get my seller financing and he gets rid of the property and he gets a little cash flow that he doesn't have to pay taxes on. And it's a win-win for everybody. And so that's the thing that you have with, as you learn different strategies, you can bring them all together and create win-win situations. Once you know what their motivation is on why they want to sell, and now you can figure out what's the best way to get them what they want and then get you what you want as well too. Emphasize value proposition. So one of the things that you want to know, you got to let them know that, hey, you're willing to keep the pace of whatever there is they're looking to do. Some sellers want to close fast and some want to close slow. And so you got to be able to be willing to be whatever you need to be to them for that deal. And so be flexible in your approach. And so also, I think one of the big things that when we start talking about what we do when we go with motivated sellers, when we deal with them directly, is really focusing on how we're going to come in and add value on multiple levels, from the community level to the property level, and being able to let them know that we're not just about to come in and take over and run the property into the ground, that we got a vision. And so I think one of the things that we're sharing with them, that our vision for the property, because a lot of times it's sentimental value. They've owned these properties for a long time, and it's a process to kind of let it go. And so for them to know and have a peace of mind and know what you're about to do and can see the future and buy into what you're about to do to the property, that they're all willing to go in. And sometimes that I've seen where they'll take a lower price because they like you, they like the vision. And so a lot of times people can be jerks, and even though they're paying more, they may not like the individual that they're potentially trying to buy. And so you're just going through it. Like, I can't really emphasize more the power of relationships and doing deals. That deal that I talked about in December, that I closed with my client, we had bought 2 properties for him a year early. And so guess what? We had bought those properties from him. We had our contract to buy this property that we bought in December had expired months ago, probably 10 months ago. He didn't have to honor it. We were still working with him. Yeah, I'm still working with the hedge fund, who was the minority owner, going through. They had to file the taxes from the year before, and they were going through all these different things to get agreement on the indemnity clauses and working through that for over 10 months. And finally, like 3 weeks before we closed, the terms like, all right, let's draw it up, get it back on paper, sign this. This is what the terms look like, and get it done. But it was a relationship. Whereas that was like, okay, cool, I know we're gonna get it done, and we're keeping those open lines of communication, and you make it happen. But you can't do that without relationship, and they're key. And then once you figure out, you build it out, you submit your offer, you maintain flexibility. If you find stuff in due diligence, you may go back and renegotiate your price and ask for concessions, just to remedy any deficiencies that you find along the way, and you get it across the closing table. And one of the big things to do, always follow up. The money is in the follow-up. Always lead with value, and not value for yourself, but value for the seller, how you can serve the seller. And be patient, be creative, be persistent, and be positive. Be optimistic. Don't focus on what if he says no? No, it's like, how good is this going to feel when he says yes? When he says, yes, I can do it at this price. You got to focus on what you want to happen, because so many times we focus on what we don't want to happen. And guess what happened? What we were thinking about, we didn't want to happen. We kept focusing on that versus focusing on the positive. And guess what? Usually the positive is going to happen. And so that's the thing that we got to go into that mind hack with ourselves on moving forward. And then expect counter offers. We talked a little bit about that. It's the back and forth. That's part of it. You're going to do that dance. And the more informed you are, the more information that you'll know how much bandwidth you have either way. Be flexible with the price. And guess what? It's not always the price. That there's situations. I can remember the $400,000 house that we had. We sold that house on Facebook with a Facebook ad in less than 60 days for 404 Palmetto Drive. And it was crazy. We were still on Airbnbs. We hadn't got back into our house yet. And we had this property that we had got under contract from a probate. It was the lady's mom had passed away. We got her property. She had called us from a bandit sign. It was funny. I had went with a different vendor on my bandit signs, and I bought it online on Amazon. Calling myself saving money, and you could write in your own phone number on the signs and put them out. And the signs were like this big, and I still like, okay, I'm still put them out. And we put it out, and we actually got a couple leads from those signs. And one of them just happened to be the lady who was going to sell her mom's house, and it was going through the probate process. And even before we had bought the property from her, she had told somebody else about the experience so far with us. And she told them, and we got a referral from her even before we even closed on her property, because they were looking, her husband was a firefighter and moving out west after the storm and was just done with it. They had contractor issues and all that as well too. It was like kind of with some other properties that we bought. And for them, the property already had a new roof on it. And it was just a couple things on the inside. And just the bathrooms had wallpaper, but it was a $425,000 house. And I'm like, you guys just need to put this house on the market and sell it. Like, I buy this kind of properties. And I told them that. I was honest with them. Like, hey, I'm not going to be able to offer a top price for this, but like, there's nothing wrong with your house. And she's like, well, still make an offer. This lady called. I'm like, okay, I'm not making an offer on this house. I'm like, I'm not paying, telling her $285 for her $400,000 house. So I looked at it 3 days later. I can remember I was sitting in the chair by the window in the Airbnb, and it called, and I literally told my wife that morning. I'm like, yeah, I hadn't called the lady back. I'm like, she's not gonna take that price. And then I looked at the phone on the table right there by the chair, and I looked at my wife, and I'm like, it's her calling back. And then she's like, answer the phone. I'm like, but I hadn't finished underwriting the property. I'm like, to give her the exact number. She's like, well, tell her that. And so I told her, like, yeah, I'm waiting for my realtor to give me the price, and so I can give it to her. And so I ended up going in and telling her we can pay $305 for the property. So she's like, okay. She's like, we'll take it. She's like, we got to get out of here. We got to have this property sold before we can buy our other house. And he has a start date already for his job. Money was not the concern. And so we literally put less than $6,000 in that property and put it on the market for $400,000. And we sold it to a pharmacist in town for $385. We originally went under contract at $400. We went through a couple of things that he wanted. He wanted the fence fixed. We didn't even fix the fence. It had a pool in the backyard. We didn't fix the fence that had got blown down during the hurricane. And so it was a couple of things in the house that he wanted updated. So we ended up taking $15,000 off after inspection report and settled at $385. And we sold it less than 60 days. And it was crazy, but it taught me that money isn't everything. That a lot of times people are really looking for their time. Time is more important than money. And so the expediency to be able to get the deal done, or be able to get rid of a problem property, or somebody to sacrifice a little extra money to be done with the headache, or be done with emotional property in your life, or something that brings pain in your life that you're looking to get rid of. So always go through and find what is the number one concern or challenge that you solve or find there. Know when to walk away. We say no more than we say yes. Coach Chris told you last night about the property. He said, they were offering, they were asking $9 million. He was like, no, the guys are trying to sell it. What is going to work that to do all this work with $100,000 in renovation? So knowing what your criteria is and knowing when you need to walk away. Or a lot of times it's stuck. We were looking, one of my clients, we were really underwriting a house opportunity in South Carolina, looking at the deal. And the more the deal really look good, guaranteed contract, 100% obviously with the school, there's South Carolina State. But one of the things that pushed the deal when we looked at it closer was like, okay, what's the use case after this once this contract is up, or if we extend it for a couple of years, what's going to happen? And when we started looking at all the new construction happening and everything that was going on in the future, it's like, okay, if they're going to be in a position where they don't need us to do contracts, like, okay, that's going to be a high risk that we probably don't want to take and look at. And so sometimes you're going to have to say no to the deal because long term is not worth the risk, outweigh the potential return in a situation. It isn't a race, it's a marathon with all this stuff. Like you get years and years of experience, you go through situations, you're underwriting deals, you get close, and then like you find out like, well, they renovate 400 units on campus. They're gonna put all the kids in there first before they put them in our building in the future. And then 2 investors are building like 100 units right across the street, brand new construction that we got to compete with. It's like, and we're talking about a market of less than like 15,000 people or whatever it is, a small market. It's like, okay, yeah, it's going to be too much capacity. We're going to be fighting over the limited amount of students, so it doesn't make sense. But a lot of times you get your heart in these deals, which you shouldn't, and you get down. Like I was so close. I thought this was the one. We were looking at like, $5,000 a month passive income, and you're like, now you're getting back to the gridiron. You're getting right back into underwriting more deals in the process. But that's part of the journey. It's part of the marathon. And guess what? It all starts with the first deal. We're getting the first deal going. And I promise and guarantee you, the first deal you underwrite is not going to be the first deal you buy. I'm pretty sure I guarantee you that. But it's going to get you close to every step that you take. So to that diversified portfolio, you want that you had $1 million per invest. And you can look at it, spread it out residential, commercial, and industrial, and just kind of do a spread like that. We got 600K residential, 300 commercial, and industrial. That's one way that you can diversify. You got geographic diversification. You can invest in one city, your second city, and third city, just kind of spread it all out over those different areas, and now you're diversified from a geographical standpoint. And then to take it to a step further, you can do property type diversification, where you got single family homes, multifamily, you got condos, and you got townhouses. So now you can look at how you can couple all those together, and now you can have apartments in different cities. You can have a couple of townhouses, condos in a couple of different cities, the different types. And now you have a diversification across multiple assets, multiple areas, and across multiple property types at the same time. Whereas now you're ultimately you're diversifying your risk just across all those different assets and across those geographical areas and asset classes. So if you want to do like an income versus appreciation, you can take it a step further. It's like, hey, a large portion of my portfolio, I want to be more about income generator properties where we get a lot of cash flow. But some of those we talked about, hey, we know they're building a new job site right here. Publix is going in. They're building like $10 million worth of retail down the street. There's a new magnet school that's going to be right next door to my apartment complex. I'll pay a little bit more because I know all this is coming in the next 2 years. And so my cash flow is going to be lower than I like, but I know my long-term appreciation is going to be on point. And so that's why you may put some of your portion of your portfolio allocated for appreciation. And then your risk. You look across low-risk properties. So your Class A, where you have like the very low cap rates, where very new construction, you may put 50% in that. But you may look at like some value add where it may be a moderate risk, where you're going in and improving some B and C class properties and doing those value adds for something that may be 15, 20 years old. And then you may put a subset of your money in like high risk properties that are like completely vacant and it's like a 50-year-old building and you're going to have to do a complete remodel. And so you may allocate some money to those type of investments. So now that's how you just go through across those different asset classes and diversify across the board, where you're not putting all your eggs in one basket or in just one project. Reinvestment of profit. So you got the opportunity where you can take the money from a deal over 5 years and looking at it, you can spread it out. And so you can continue to grow, reinvest profit from your rental portfolio, accumulate it, and then buy assets with it. And then you can also look at, long term, like, okay, what's the projections on if I take that money and then I buy more assets and continue to compound it, where I take it $50,000 each year, I buy a new asset for a down payment and it's producing more cash flow, and then I just keep repeating that for 5 years. What does my portfolio look like with buying those additional assets? Then leverage. We talked about leverage earlier in the week. with being able to have the bank come in and provide a 75 or 80% loan to value with it, whereas that now you can buy an $800,000 property with $200K. And one of the examples that I love is you talk about if you have $1 million in the bank in your retirement account and you're doing a distribution of only 4% of your money each year that you live off of. So 4% of $1 million is 40,000. So if you can go buy a property, you put $200K down and it produces, and the bank gives you 80%, the other 80%, whether it's 800,000 and you put $200,000 down, and it's producing $5,000 a month passive income, that property is producing $60,000 a year in cash flow. Now think about it. You got an IRA that's $1 million. You only can take 4% a year to live off of. It's $40K a year. Now you take only $200,000, buy an apartment complex. The bank gives you the other $800,000, and your cash flow after expenses is $5,000, $60,000 a year. So now you're gonna make $20,000 more a year, and you're only spending $200,000. And that's the power of real estate and the power of leverage, because now with only $200,000, you get more passive income than somebody that has $1 million in the bank and living off of it. And you get the bonus depreciation, you get the residence that's paying down your mortgage each year, and you get the long-term appreciation over time. And you only spent $200,000 versus $1 million. And living off that money. And so that's the power of leverage that you can do with buying the right asset. And think about that. If you own 70% of that building that's producing that money and 70% of that income stream, and you raised all the money, you didn't have to put no money down. And you're getting an infinite return to make $2,000-$3,000 a month. But you raised all the money and you gave them half of the cash flow goes to them because they put the money in the deal, and you get the other half, but just managing the deal and finding the deal. Like there's so many ways you can put this together in order to be successful. All right. Portfolio optimization. And so now I'm just kind of talking about it's like as your portfolio grows, you look at selling things off, taking equity out of deals to buy bigger deals, or doing 1031 exchanges and moving that money into other projects. So that's the thing that you look at. It's like, okay, if I grow my portfolio 10% annually over time, then that, like in this case, if you got $1 million portfolio and the increase in value 10% in a year, over 5 years, then how that $1 million goes to 1.6 million with that annual increase of 6% a year. That's the thing. Like once you start making progress and you start building, it scales up fast. The number goes faster and faster. Whereas now you're talking about $20,000 and $30,000. Like okay, depreciation, every month 2 or 3%. We just saw where prices went up from 21 to 2, 14%. So your portfolio did you higher inflation environment, and you got $1 million portfolio. You just got $200,000-$300,000 in value in just 2 years just from holding it, just being there, because we know inflation is going to take the value of the money down. And so that's the thing where you can look at how you can optimize your portfolio over a long period of time. So strategic partnerships, partnering with other people. We talked about this with joint ventures. Example of that. We're going through with that case, and then also looking at some of the additional long-term vision with what that looks like, with being able to focus on the long term and not just having a near term. We're looking at trends, the growth that's happening in the area, on how you can leverage your portfolio to benefit, looking more long term. And just thinking out what a horizon of where you want your portfolio to be in 15 years, that you might set a target portfolio value of $5 million. Or, like we were talking about the other day, when Chris said he wanted 1,000 units, he's like, okay, hey, how much time are you going to give yourself? And let's start the process. And what does that look like to get there? But the good news with all of this is you don't have to do this alone. And guess what? When you're not doing it alone, you get there a whole lot faster. And the secrets for most successful investors, and I tell you, we talk about it. We talk about the title of my book about them not teaching this stuff in the school. That like once you learn how to take action and how to get the information and execute consistently, that it gets you in the game. But the next step is you guys want to learn how to stay in the game. And then that's what we're going to talk about as we kind of get off the stage and wrap up tonight with the 4 C's of mastery: collaboration, connection, community, and coaching. And how do you bring those 4 C's together to kind of execute and scale up in a short amount of time? Collaboration. According to research, investors who actively collaborate with others tend to achieve higher returns and mitigate risk more effectively compared to those who operate independently. Like, collaboration is like super critical to being able to scale up and to be able, because there's a lot of different moving pieces. There's a lot of different nuances. For the collaboration was cool today. I talked to 2 other of my clients that were collaborating on an RV park deal. We sat down, got on the Google call this afternoon, and going through and collaborating and looking at where to deal together, because one brings the underwriting to the deal, and the other one brought the deal to the table, and they were collaborating, coming together like, hey, and presenting like, hey, what do you think? Is any blind spots? Did we miss something? Anything else that we should think about? But being able to collaborate, now you have one person in one state, another person in this state, and now they can collaborate on a deal and bring their powers together where one's located there, one has the underwriting analysis, and then both can raise money for the deal and create a win-win situation for everybody involved. So yeah, I want you to talk about that example. I just gave you a great example that was like real time that they did. The connections, like this was a cool one. Networking, like network. Your network is your net worth. Your network is your net worth. This is one of the key drivers to success in real estate investing, and being able to work together. I can't, like, my first multifamily deal that I did, that my guy Rory that came in on that deal with me, the one I talked about that got the 17% ownership in there, he brought 40K and then raised the other 35K, and then my college buddy. But I met him like a month earlier in a mastermind group that I had joined. It was a military-centric real estate community that I had joined. And just by talking about my deal, like, hey, yeah, I want to get general partner experience and get in on an apartment deal, and I got some money. Like, cool, let's do it. I'm like, we just met, but I know, like, hey, you're a Marine vet. You seem like a cool guy. Family man. Like, hey, let's go, let's do it. And that's just the power of the community. And it was funny, like yesterday I was in Atlanta at one of my mastermind events, and one of the things like with coaches, like the people that pour into you, you need to make sure they have somebody that's pouring into them, because like eventually, if you don't have somebody that's being fed and they're always feeding other people, you're gonna run out. And so that's one of the things, like I had to make the sacrifice. I'm like, my challenge is going on this week, but I can't miss this quarterly event and make it happen. And so was able to get down. And one of the cool things was I was talking with a young lady that teaches people on how to bid on commercial cleaning projects. And she has a commercial cleaning company in Pittsburgh. And the first thing that came to mind was, oh, great, I got a client in New York City that has a commercial cleaning company. I'm like, you guys should meet. And she was like, yeah, that'll be great. And so like being able to be in a position to make that connection, from a networking event, like, yeah, I'm like, you guys kind of in the same space. And it was funny because she has a 3-story commercial retail space that she don't know what to do with. And so she was talking about some different things with working with the city, like for housing, people who just got out of prison that needs, room and board, things like that will be paid for by the county. I was like, yeah, you definitely need to talk to my client, because guess what? I teach her real estate. She's learning real estate. I'm like, y'all may be able to collaborate and put the connection together. But that would have never happened if I didn't know them and I wasn't in Atlanta and having those conversations, able to put that together. There's so many different opportunities where people know what it is that you want. We were talking about with, guess what? If you're not sharing and telling everybody what it is that you're doing, then nobody's going to know what you need to get help with. And so the more and more you share about what it is that you're doing, the opportunities you're looking for, now you have more opportunities for people to help and serve you and help drive success. Everybody loves to connect people and build those relationships. And I think about just a relationship. I told a guy today that had reached out to me about doing a bird deal on LinkedIn, and we were sharing, like, oh, you do look like you're a veteran. I'm like, literally in the airport yesterday, had a conversation with the president of Home Capital. Does most of my hard money lender, them me today to get a preference on my rates. I'm like, And I asked her, hey, when I get people referral, how do you want to connect with them? She's like, I'm a phone call person. So I said, hey, here's Rachel's number. Call Rachel and tell I told her to call, and she'll hook you up. And he was eternally grateful because he was struggling trying to figure out who his next lender was going to be. And so that's the thing, just for connecting. Like I just got countless stories to think about. And that's just 2 stories from yesterday, with just being able to always think about connections and putting people together. And then the next thing, going through as we wrap up, because time, the internet connection got me tonight, is community. And it's just being able to highlight different mastermind groups, the effectiveness and driving results. And I told you guys, just like that first deal with me, Rory, in the mastermind group. And I can't even tell you, I just got so many, stories of just people that I've met in different communities, different rooms that I've been in, rooms that I had to pay to be in, to get in just to have conversations. And, the event yesterday that I went to, and just being able to collaborate with other like-minded entrepreneurs, whether it's real estate, whether it's just professional development or whatever it may be. But the community is one of the things that's going to accelerate your learning, accountability, and just being able to have those connections. When you're serious about something, to where it's going to continue to fuel you, re-energize you, and push you to your greatness at the end of the day. And then the coaching aspect of it, coaching and mentorship, that you got to make sure that it's a good fit for you as the mentor and for you as the mentee, on who you align with, because that's a big thing. And then just going through and understanding what it is that the experience that they have, and make sure it's what it is that you're trying to get, where it's a good fit, and that can help you be successful at whatever your goal is, whenever you're looking at like the coaching aspect of it. One of the things I started coaching a couple of years ago for one of the intelligence agencies that I work with being able to work with junior officers to help increase their performance in the workplace, with being able to coach them, and not necessarily mentor and tell them what to do, but really coach them, because your job as a coach is not necessarily to impose what you want them to do, but it's really to take the beliefs, take the needs and wants and goals of the individual, and then take them as an individual, what they already have and how they're already showing up in the workplace, and get that performance out of what they bring to the table already. And that's the job of a coach. When you start looking at LeBron James or Michael Jordan or any of those greats, that the coach just comes in, they didn't make them great. They had that God-given talent. Each one of you already had the God-given talent inside of you. It's the coach's job to take what's already in you and perfect it, whereas that now you become championship caliber by being able to take what it is that you already have. And really just going through that, understanding that, hey, achieving high levels and the great confidence that comes with that, it comes from just that interaction with coaching. Then you just got all across the board. You got my Roll Tide Alabama football right there in the center, Nick Saban, one of the greatest, if not the greatest college football coach to ever do it. Manny Pacquiao, Tiger Woods, the greats Kobe, Mike, Shaq. They all had coaches that helped perfect where they were, who they are, what they do, their trade craft, to get to the next level. Because before Phil Jackson, Michael Jordan hadn't won anything. He had been in the NBA 8 years. And he was great, scoring 30 points and doing great personal stats, but he couldn't win and lead the team until he met the right coach. And the same thing with Kobe and Shaq. There's the struggles they had until Phil Jackson showed up. And you look at Nick Saban, 7 national titles at the University of Alabama in the process. And Tiger Woods is one of the greatest golfers, still had a swing coach, changed his swing middle of his career. And the list just goes on and on, just the benefits of coaching. And the thing, when you start looking at the mastermind concept and having different brains solving different problems and the collaboration, if you look at the advisory board, who sits on the boards of a lot of these companies, they're all masterminds. They bring in a lot of general officers, military people to these boards because they think different. They went and fought wars. They have a different, diverse skill set that they bring to the table. And corporate companies, they want that diversity in thought that they bring to the table. And it's nothing more than a mastermind group. You had different people, experiences. You had the CFO, the operators, the CEO. You have your managers. You have your lawyers. You have your accountants. You have your HR people. You all have people that have different skill sets over the years and experience that all come together for the mission that they have at the company level, and what the mission is for that company, and execute it and now they move out. And you can see that, hey, they're pretty successful with the people that they have on their boards, that they get a job done. Because you look at some of these companies, they've been around decades on top of decades with how they do business. So one of the things I'm gonna ask Henry to come up, that it's been a crazy week. Like, it's been so much going on this week. And I had a conversation with Henry via text earlier, and we had a phone call as well too. And I'm gonna stop sharing for a second and bring him, because I want kind of him to share his story a little bit with this week, and then when we talk about today, I was like, I was blown away. I sent him a text and asked the question. I was like, what? I'm like, we need to talk about this. Bring it up. So I'm gonna bring Henry up. Then can you pin both up on the screen? I think he's on.
Hey.
There he is.
Yep. What's going on, man? What's going on, everybody?
Well, I'm with that for a while. What's that behind? I see purple and gold behind.
Hey, I'm at Papa House.
Okay.
I will have MJ back there.
Oh,
yeah, you know I have MJ back there. You already know.
You already know.
But I have that Mamba mentality though. It's real.
That's it. Tell us about the deal. First of all, congratulations. And but yeah, tell us about the deal a little bit.
Yeah. So we found the deal, and one of my tactics is to find homes in great school systems. That's the niche here in Augusta. Speaking to the military, it's a big military town. I talk to people where they want to live, and everybody says Columbia County, 30907. This is the area code I want to live in. So that's where I focus a lot of my energy in that area. So with this specific deal, it was a real good deal. It was vacant for like 6 months. Great neighborhood, close to base, close to all the amenities, Washington Road, downtown, Masters, all that good stuff. So I got it for about $250. I did about $35K in renovations to it, and it stayed on the market for about 60 days. But just to give you a little background on it, I first got it. I did my inspections, got my contractors in there, and I ended up losing my initial contractors. So it took me about a month to find another contractor to get in there and fix it. So as Johnny always say, you got to have your plan A and your plan B. So I got my second ones in there. They got it done, and it stayed on the market about 60 days, and we just came under contract.
You can't beat it. Now we ain't gonna go into the details, but I know you raise a little money too on the side as well, don't you?
Yeah. So as you said before about the connections, and for the two properties that I found, they in prominent areas to where nobody moves, nobody leaves. So that can help you, right? And that can hurt you. So when it comes to lending, it may hurt you because there's no comps, right? Because no one's moving. But the upside is when you fix it and you sell it, there's a shortage. And if you're in a prominent area, the value is, you pretty much set in the market. So we found two of those opportunities. But the thing is, on the lender side, we didn't get a lot of cash. So I had to raise money. I never raised money. So that's not my thing. I'm a project manager. I like being on ground, like being with the people. I like finding the properties and letting someone else do all the other stuff, right? But when the situation dictates itself, hey, you got to feel comfortable being uncomfortable. That's real estate, right? Yep. So I built my little deck, built my little pitch, sitting at the Johnny like, hey, man, hey, ink it up, read it up. Hey, give me the rundown, what you think. But one of the things that I like doing is I like to give people as much detail as possible. Like, why is this important to you, and why is this important to the community? So I pitched that. I was on so the connection piece, right? So I'm in a huge military network. I served 22 years, still serving. And like Johnny said, you got to tap into your network. And I can't stress this enough. you have to let people know what you're doing. You have to be on social media. And I'm a big real guy. I like teaching. I like showing people what I'm doing, the impact that I'm making. I just like being visible because, like I said, you never know who you're gonna inspire, and you never know who's watching. So I constantly get DMs of people like, "Hey man, I'm gonna hit you up at this point in my career. I'm gonna hit you up here." So I had one of my friends. She was like, "I want to get into real estate. I just don't know how." And she's been telling me this for a couple months now. So me and her had lunch. I told her about the opportunity. Actually, she told me about another opportunity that she was considering.
Mm.
But she was edging me at, "Hey, do you have anything available that you're doing here locally?" So that's what kind of got me to thinking like, okay, I might need to bring her in. So I was telling her about the deal, and then she was saying that she had a friend that was wanting to invest as well. So I built my deck, showed Johnny, he shot it back, added my details to it, did a Zoom. So about 15 minutes, I raised $90K.
You raised $90K and how fast?
In 15 minutes.
Man, I know people that work a year.
That's crazy.
Yeah, so the biggest thing was, so a friend asked questions. The person that I knew, she was pretty much sold because she's seen what I've been doing, and she knows me. She knows my work ethic, and and like I said, she wants to get into real estate as a passive income. She wants to be a passive investor. So her friend was pretty much just asking like, okay, so tell me a little bit about yourself. Tell me a little bit about why you in real estate and what's your overall vision. So I was just telling her the vision on how I'm trying to build a coalition, how I'm in the group and other like-minded people doing this, because she's prior military as well. So what I'm looking to do, long-term thinking strategic partnerships, is after she sees this product, bringing her into the wider network. And it's about building a coalition. And the strategic vision is multifamily. These are stepping stones to get us to the real generational wealth.
Let's go.
Yep. So yeah, 15 minutes. She was sold, and I was only looking for 60K out of the meeting. And she said, "So what if I invest 60? Would I be able to do that?" And I was like, "Okay, well, we'll make it work. Here's what I can offer." And and she was sold. So I went in there only needing 60, and I got 90. So and that was my first experience doing anything as far as capital raising. So I know it's probably a unique experience, but I just wanted to share with y'all to saying that, hey, at some point, if this is really what you want to do, you're gonna have to go out and bet on yourself, not take a risk. Bet on yourself that you're comfortable in what your ability and what you can do, and just put it out there and just see what happens. And that's what I did in that situation. I just put it all out there, and I was gonna get a yes or a no. And whichever response I got, I would have kept on moving to the next phase to see what I needed to do to get to where I need to go.
No, I love it. I love it, brother. Salute. Super proud of you, man. Hey, keep grinding, keep pushing through, man. And we're gonna chop it up, get a little bit more detail on these Wednesday nights.
Okay, sure. You know it.
That's awesome. No, I'm glad Harry was on here where we could bring him on, and instead of me talking, telling his story, let him give his own testimony. But that's the thing that I want you guys to be encouraged and just know that we're all ordinary people. We put our pants on one leg at a time, and we're just out here, hey, we're doing the work and getting it in. And one of the things the biggest thing is that you got to be comfortable. You got to get comfortable with doing all this stuff. And the more reps that you get, the higher your comfort level is going to be with it. But that's pretty much it. We're wrapping up. But one thing I want to ask, are you guys glad that you came out this week? I know it's a sacrifice. We started with, I think it was about 26, 27 people. It's only 15 people online. I know we went a little longer tonight, but that's okay. Hopefully they watch the recording. If not, that's okay too. But I just want to kind of get some feedback from you all. Just, what did you guys think? Was it impactful, worthwhile, good execution of your time?
Man, I mean, bro, you just dropped so many gems, man. And you just devote so much time. It would be foolish not to tap in to every single boot camp that is provided. Cause you just give free chicken, free knowledge. I mean, it would be foolish. Like I said, I still tap in after a year. I'm still tapping in. And I'm gaining something new every time I tap in. So definitely, bro, I salute.
No, I appreciate it. But the biggest thing is, like, I want everybody to walk out of here at the end of the week knowing that you have what it takes to get to the next level, to start taking advantage, understanding what's going on in your market, building up this skill set in order to build wealth. And we kind of talked about what Henry was talking about. I like for people to really dig in and know that you can do all this stuff too. One of the new things that we ended up doing was building out within REI Genius the community in regards to what we offer in regards to new investors that's trying to come on board, and just really empowering people and helping them, one, get the knowledge, the information, the support that they need, but then off the network. Because I'll tell you, like, over the years, the last few years, like with all the mastermind groups, I know I probably spent over 100,000 the last 4 years on just education, professional development in myself. And like being able to have the thing, even for the high ticket stuff, like it's the hardest part is having somebody that you can talk to, that you can pinpoint and run down. Like they put you in a room and force you to network a lot of times. And they're like, hey, go network and find whatever it is that you need, and good luck. But I think that's the biggest thing, that as a newbie and starting off, is really having access to the people. And so I think one of the things is like having those resources, the tutorials, being able to be around like-minded people that, that's trailblazing, exchanging those ideas, the strategies, the different experiences from people that's, flipping or commercial real estate side, wholesaling, people that's passive investing, doing subject to deals, whatever it may be, to be able to have that community of people. Because when you go to work, you go to your normal job, your normal day, like nobody's talking real estate, nobody's talking building wealth. Everybody's talking about the next PowerPoint, the next meeting that you got to go through, and the next read on why you can't get you a raise, or why you can't take this amount of vacation day, can't take this much time off, just everything else you have to deal with. But one of the things, we rolled out was the peer-to-peer learning and support that comes in the community. Live webinars, the workshops, events that we're looking to roll out here in DC, where people fly in for those events, and it's going to do a couple down south, coming some of the areas where we got properties. Then also laying out like the different courses, investment tools, material that you all can get within the community. And if you're interested, then definitely I encourage you guys to kind of go to the REI website. We got everything up there. You can go tap in and learn. It isn't free. Towards the resources we bring in. It's $97 a month for the REI Genius community. That is separate from my commercial multifamily mastermind group. That I'll give you a little bit more information what that is for those that's specifically looking at the commercial multifamily piece and the raising capital and just kind of learning how to invest passively in deals that you can apply to join the community. And we'll kind of have a strategy session, myself and Coach Jessica, and kind of make sure that it's a good fit for you to get in. And so we get that process. But of course, we talked about Henry's success. Right here, Chandria Poole, she's using her self-directed IRA, buying assets in the Atlanta area. She's bought a duplex. Most recently bought some land. Well, actually, the land on the contract, working to do a new development, single-family townhouse in the Atlanta area as well, and all leveraging her self-directed IRA, buying real estate with her retirement account. And just the information and like the 5-day training that we have in there that you guys get, we're going through. We're helping you get real laser focused on like what it is that you need to be doing from a marketing standpoint, going into some of the details, the different strategies that you have out there, and with that. And then you just got other people that's doing deals. Jay's in the Chicago market, did a wholesale deal with the single family that's just going out here and just execute and crushing. And that's the thing. You want to be around people that's crushing it, that's out here taking action just like that you're doing and what you're looking to do in the future. Whereas that you know that, hey, you got somebody behind you if you got a question, and then you got somebody right there running with you. Because guess what? If you're running out there by yourself and you got stopped, you get tripped up, there's nobody around you to pick you up, then guess what? This may take you a little bit longer to get up. But if somebody's right there beside you, you might not even fall. Because if you get tripped up, they're going to catch you before you hit the ground. And that's what it's all about. That's what the community is about, with everything that we're doing. And would just be honored. Hey, if you're motivated and ready to tap in, we would love to kind of go through that. And a couple of the bonuses that we're going to talk about. Coach Chris was kind of going in and just sharing with the achievement and the goals and everything. And that's one of the things too that we had added in there with him is his real estate leadership bonus that we're going to talk about with him. But he's doing a series, and so we're continuing to do more workshops. I think next Monday we have my guy Mike Gillespie coming in talking about bookkeeping. With my CPA Larry, we're gonna have him coming in after tax season kind of winds up a little bit, just talking about real estate tax rate, because you want to plan your tax strategies now for 2023, so you can make decisions and make the right moves. So when you're filing your taxes in 2025, you're gonna be good to go. And so the time to do that is kind of now and not at the end of the year when it's too late. But the big thing with all this is when you start talking about the price of inaction, like we talked about where the gross profit around $70,000 for flipping one house. If you can do just one deal a year, what could you do with an extra $70K? And it's like now you not taking action on actually implementing that and doing the deal, that now it's costing you $70,000 a year, not being able to know how to do a deal. Or actually you know how to do the deal, you just choose not to do it. And it's like, okay, what's that cost over 5 years? We're talking $350,000. Over 5 years of inaction, what it's costing you not to do something. And so I just want to kind of leave you guys with that, to be thinking about, hey, you sitting around not taking action on your dreams and being scared and fearful is really holding you back from a whole lot of potential and wealth building that you can bring in for you and for your next generation with that. And I kind of talked about just the last slide as we wrap up in regards to if my computer actually works and clicks through. Frozen up. Go back one with this. But the thing is, you could be the next millionaire. No kidding. That we talked about the billionaires out in the real estate space. Like the only thing that is holding you back is you, that you can make that decision kind of going forward. Solve it. And I'll skip through all this. One of the things that we thought of a few months was with the community was support on demand, being able to go into the support on demand, get feedback myself from anybody on my team with Faye through, hey, I got a deal. I had somebody hit me up. And he's like, hey, man, can we do a JV together, just a cold message on Facebook? I'm like, yeah. I'm like, no, probably not, man. I'm honest with you. It's a lot of risk. We talk about, we do the JV, I got to sign on the loan, I got to do this, like, we need to work together. We don't have a relationship, so it's really hard for me to say that we can do that. But this is the thing. It's like going in, being able to get feedback, support, demand, that you build that relationship. Talk about Chris Real Estate Master Leadership Series. Guys that coming in at the phone, and one of the things too that him and I talked about today was the DISC 7, where you understanding the personality traits that you have, how you make decisions. I think that one goes really, really good into how you show up in conversations, negotiations, all of that. And you can pick up on other people's decision-making process and their personality. You know how to meet them in those negotiations, just kind of based off the conversation that you have. And in the Real Deal in 90 Days, that training that we were talking about, you guys get that rolled in too. And that last one there is for those that's thinking about, hey, I want to get in the inner circle, the commercial mastermind. Then the 6 months of group coaching, the weekly sessions, the accountability groups, the deal desk for potential partnerships and getting access to all that. With all that, we talked about the capital raising support. We're bringing me in to help with some of the deals, the broker data, the capital raising course, and just being able to raise money and what that looks like with a presentation, how to present the deal, how to leverage the community when you're going through. Whereas, because I tell people, like, You don't have to do deals. Let them know, hey, I'm part of a group. I got coaching. My coach has over $14 million real estate portfolio, 120 doors, and this is what we do. And we got a group of network of investors, that's ready to buy deals, and we can negotiate a really good price and move out. But just having that deal that supports all the documents that you need. We talked about that, with over 5K for just the documents for that one deal. And a host of everything else for the calculators, everything that you need is right here in the group. So if you guys are really serious in the next 6 months, you're looking to invest passively in a commercial deal, you're looking to get smarter on making the transition from single family to multifamily and being a better operator and doing that, then definitely I encourage you guys to kind of get on the calendar, apply, talk to myself and my team. We'd love to have a conversation and making sure that you're a good fit for the community, and we start getting after it. At the end of the day, success comes to those who are willing to launch toward their goals with no guarantees of success and persist when there's every reason to give up. Because you're gonna get plenty of opportunities to give up along the way, but those are successful. They just keep going. We don't stop. That you guess what? You break my legs, I'm coming crawling. I'm still moving. As long as I got breath in my body, and that's what it's all about. We're moving forward because guess what? Our mission, our why is that important. And I want each and every one of you all that's on this call to know you are worthy of everything. You're worthy of this success that we've talked about, all these other people that's found success. You're just as worthy as everybody else is of achieving success. But you just got to take action and move out like you believe it. And because nobody can do it for you. Like Coach Chris said last night, that you can be successful if nobody believes in you, but you'll never be successful if you don't believe in yourself. And so that's the thing to let you know, I believe in you. And if you're ready to run, we're running. Come on and get in line and catch up with us because we're moving out. And that's it. I'll stop sharing the screen. I know time has been well spent. Why with the delays and everything, 2 hours is 10 o'clock at night on a Friday night. So I appreciate you guys. I'm hanging out for questions. What you guys got, let me know. What can I improve on? You can tell me in public, you can shoot me a message, let me know. Because we're always looking to get better and love feedback. And but yeah, I'm hanging out. I know it's late for some of y'all. Henry, I know you gotta get out of here. You're on the road with family.